Welcome. The past few days have been emotionally draining for investors in precious metals. What we've just witnessed is not an ordinary pullback. It was a historic sell-off, the kind that leaves a lasting mark on market psychology. If you hold positions in gold or silver, chances are you're feeling conflicted right now. Shock, anxiety, doubt, and maybe even disbelief, all hitting at once. To understand where we are, we need to carefully unpack what actually happened. Gold had been climbing relentlessly, driven by a powerful mix of macroeconomic fears, geopolitical tension, and eroding confidence in fiat currencies. That rally ultimately carried prices to an all-time high in near $5,600. Momentum was strong, sentiment was euphoric, and many believed the move was just getting started. Then, almost without warning, everything reversed. In a window of less than 48 hours, gold collapsed to roughly $4,700, an extraordinary drop of $900 to $1,000. On one Friday alone, prices fell more than 9%, an extremely rare event for an asset long viewed as a symbol of stability. When markets reopened on Monday, panic selling continued, with losses reaching another 5% at certain points. This marked the sharpest pullback in over a decade. For an asset class typically associated with safety and capital preservation, this degree of volatility was highly unusual and deeply unsettling. If gold's decline was shocking, silver's collapse was outright brutal. After peaking at an impressive $121.48 per ounce, silver entered a near vertical freefall. Prices plunged roughly 40%, eventually falling to around $74 per ounce. This wasn't just a correction, it was a complete unwinding of speculative excess in a matter of days. Naturally, investors are now asking critical questions. What caused this sudden reversal? Has the bull market ended? Should positions be closed, reduced, or held? Was $5,600 the final peak for the foreseeable future? These concerns deserve a structured and unemotional analysis. The immediate catalyst came from the announcement of a new candidate for chair of the Federal Reserve. Markets had been positioned for continued dollar weakness, aggressive monetary easing, and prolonged currency debasement. This expectation formed the backbone of the bullish thesis for precious metals. However, the perceived policy leanings of the new nominee unsettled that narrative. Investors began to speculate about a possible shift toward tighter monetary discipline, evoking comparisons to the Volcker era of the 1980s. Even the possibility of a return to credibility-focused policy was enough to disrupt the prevailing consensus and trigger rapid repositioning. As analyst Susie Cooper of Standard Chartered noted, prices had already become stretched, making a correction overdue. But the combination of a surprise Fed nomination and shifting global capital flows created the perfect environment for panic selling. At the same time, the US dollar rebounded sharply from its 4-year lows. A stronger dollar immediately makes gold more expensive for international buyers, reducing demand and accelerating downward pressure on prices. Geopolitics also played a major role. Heightened tensions in the Middle East had been providing substantial support for safe haven assets, but that support weakened abruptly as diplomatic developments emerged. Reports of meaningful negotiations between the United States and Iran signaled a move away from military escalation. Statements from both sides emphasized dialogue over confrontation, dramatically reducing fears of an imminent conflict. As the perceived risk of war diminished, the safety premium embedded in gold evaporated almost overnight. Despite the severity of the sell-off, perspective is essential. This correction effectively erased gains accumulated since January mid-20, when geopolitical risk premiums surged due to concerns surrounding Greenland and European trade tensions. That premium has now been stripped out, but this alone does not invalidate gold's longer-term bullish structure. Gold's rise to $5,600 wasn't arbitrary. Around $5,500, the total global value of all gold reached approximately $38.2 trillion, nearly matching total U.S. government debt of about $38.5 trillion. This convergence is historically significant. For the first time since the collapse of the Bretton Woods system, gold's aggregate value approached parity with U.S. sovereign debt, highlighting deep structural stress within the dollar-based global credit system. At the core of gold's long-term strength lies a gradual but persistent loss of confidence in dollar hegemony. Political dysfunction, rising debt burdens, and monetary instability have accelerated the process of partial de-dollarization. Interest coverage ratios, measuring debt service costs relative to government revenue, have steadily risen since 2021, now exceeding 18.5%, well above the 15% warning threshold cited by major credit agencies. Servicing debt is becoming more expensive, reducing fiscal flexibility and long-term sustainability. Meanwhile, foreign ownership of U.S. Treasury securities has declined from 34% in 2014 to roughly 25% today, signaling weakening global demand for dollar-denominated debt. This shift is uneven. Asian central banks and emerging markets are actively reducing Treasury exposure and accumulating gold. Traditional allies, including the UK and Japan, continue to absorb U.S. debt, but the divide is becoming increasingly clear. Notably, since early 2025, most gold price gains have occurred during Asian trading hours, confirming the dominance of Asian demand. The United States now faces a fundamental trilemma. It cannot simultaneously maintain low inflation, low interest rates, and dollar dominance. Something must give. Historical precedent shows that restoring credibility through aggressive tightening, as in the Volcker era, would be extraordinarily painful today due to vastly higher debt levels. The more politically viable path is currency debasement, accepting higher inflation and a weaker dollar to reduce real debt burdens. That choice erodes long-term confidence in U.S. debt instruments, and gold benefits directly. My assessment is clear. The gold bull market is not over. For it to truly end, the U.S. would need to restore comprehensive confidence in its fiscal discipline, currency stability, and institutional credibility, an outcome that appears unlikely given structural constraints. In the near term, caution is warranted. Bears retain tactical control while prices remain below short-term moving averages. Volatility and consolidation are likely. Key support zones include the 30-day and 60-day moving averages, offering more favorable risk-reward opportunities than chasing rebounds. Looking ahead, I expect gold to recover and challenge new highs, potentially reaching the $5,800 to $6,200 range by year-end. Over a 1 to 3 year horizon, prices in the $7,000 to $8,000 range are plausible if current structural forces persist. Still, objectivity demands acknowledging alternative outcomes. Genuine monetary reform, transformational productivity gains, geopolitical stabilization, or direct regulatory intervention in gold markets. These scenarios are possible but remain low probability. Rather than panic selling or aggressive speculation, disciplined accumulation, prudent risk management, and patience remain the most rational approach. January 2026's collapse is best viewed as a mid-cycle correction, not a final top. Short-term pain often precedes long-term opportunity. As always, this is a personal assessment, not financial advice. Do your own research, understand your risk tolerance, and act accordingly. So, what's your view? Is this a buying opportunity or a warning sign? Share your thoughts, stay informed, and trade carefully.